Again, welcome everybody. How to trade broken wing butterflies for income with Matt Williamson. My name happens to be Don Kaufman. I'm doing a quick introduction here for Matt. As I said a moment ago, he is one of our newest instructors here at TheoTrade, and we're really happy to have him on. Let's get into this a little bit. First of all, a risk disclosure. We're not financial advisors nor a broker-dealer. Great. No soliciting, no recording, no photography, right? That just means, don't take pictures of the monkeys, don't feed the monkeys. Next, copyright disclaimer. This is ours. This is not yours. You have to have the express consent of the National Football League, apparently, to replay this. Nevertheless, we are actually going to send you recordings. That's always important. The other reason that we throw this up here, and we want you to know this right up front, you can contact us. You can always hit us up at support@theotrade.com. The other thing is, as Matt is going through tonight, I am going to be answering questions in the chat room. JP is going to be answering questions. Jeff's going to be answering questions. We're here to support you guys. Again, support@theotrade.com. Also, of course, our office is based in Scottsdale. However, Matt is broadcasting from far, far away, Alabama. Next thing about TheoTrade, we specialize in education for stocks, options, and futures. I recognize that many of you this evening, anybody here brand new, never been to a TheoTrade presentation before? And again, even if you're watching this in the recording, throw your hand in the air and be like, yes, okay? A lot of people joining us this evening, and lots of people are new. So if you know nothing about TheoTrade, we're founded by professional traders and trading educators. Everybody on the crew here has got a minimum of 15 years of experience, several with a few decades. And we're here predominantly to help you guys mitigate risks in the marketplace and learning a skill set that can last a lifetime. The other aspect about TheoTrade, and this is one where, I like to come on, do a little bit of an introduction. As I said, Matt's one of our newest instructors, but TheoTrade is not a one-trick pony, meaning that we don't have one instructors, and we cover a very large spectrum, a very large genre of trading. So these are the instructors. We have Jeff Bierman, who's an analyst trader. He's the former chief technician for TD Ameritrade. Jeff actually worked in my group, specifically at TD Ameritrade, and that's a highly coveted position. If you've ever been in the thinkorswim charts, for the most part, Jeff decided over half the studies that are on the thinkorswim charts, Jeff actually helped create many of those. Next, Don Kaufman. That would be me here, co-founder of TheoTrade. Self-proclaimed volatility super geek. I like that one. I started my trading career the late 90s, joined thinkorswim, then eventually became public to TD Ameritrade, left there in 2015, of course, launching TheoTrade, Corey Rosenblum, senior strategist, swing trader, Brandon Chapman, CMT, macroeconomics, technicals, and fundamentals. Brandon is actually one of the newer instructors as well. Steve Slim Miller, 43-year veteran stock options futures. Slim, he ain't new, 4 decades behind him. Last but definitely not least, Tony Rago, our Nasdaq futures and intraday strategist. So this happens to be 6 instructors plus none other than, who I'm going to introduce right here, right now, which is Matt Williamson. As I said, Matt is one of our newest instructors. And one of the things is when we, pull a new instructor up, give credit where credit is due. I actually found Matt, and we've got a really deep bench over here. We'll continue to bring on instructors, over the months, over the years. And when I say we have a deep bench, and we're lucky to have Matt, Matt is somebody that a few of the traders / risk managers at TD Ameritrade originally turned me on to. That Matt was an extraordinary trader. He said, this is the guy you should give a phone call to. So Matt is known as kind of a market neutral option strategist. He's a risk manager for a private hedge fund. Okay, so he is currently managing money. Began paper trading at age 9. Just for argument's sake over here, he still looks like he is 9 years old. Began investing in 2003, began trading options in 2010, and specializes in complex position management, Greeks, risk analysis, and wing spreads, butterflies, condors. So without further ado, I am going to turn this over to Matt. Hopefully, I'll be able to help answer some questions later in the session. So, Matt, by all means, have at it.
All right, thanks for that, Don. Hopefully everyone can hear me. I have not done a little sound check, but if anything is wrong with the audio, please let me know. Thanks for that. And I'm not 9. I'm just shy of 11. I'm in my mid-30s. Feel 9 sometimes. My wife would tell you that I'm 9 at times. All right, so what we're going to do tonight, we are going to cover quite a bit. We are going to learn something I call the FruitFly trading strategy. And we are going to learn the difference between what that FruitFly is and every other income trade in the trading ether. If you've been around income trades and retail trading, kind of ether as I call it, there's a lot of stuff out there. Okay, there's a lot of stuff, a lot of people pitching a lot of things. And so we'll talk about what the difference is between the FruitFly trade and all those other things you've probably come across. And we'll talk about, of course, the benefits of trading the FruitFly. We will talk about the top 3 mistakes novice butterfly traders make. If you've never traded a butterfly before, you will get something out of this because you will go into butterfly trading knowing what not to do. All right, and this is the presentation I wish I could have seen many years ago. And then finally, I'll tell you the only 2 things. There are exactly 2 things that you need to make money in this market. Just 2 things. Okay, I'll tell you what those 2 things are. All right. So Don already gave me a little introduction, but just to give you a little more color, I have been down the road of shiny objects. Sorry, my microphone just fell off my desk, but with cat-like reflexes, because I have the mental capacity of an 11-year-old. I caught it! All right. Oh, there it goes again. I'm just going to hold it. All right, I've been down the path of shiny objects. All right, if this iron condor is not working, let me try this, this new trade, this new thing, that thing's not working, let me try this new thing. I have chased every shiny object there is in the book to chase. I've traded naked puts, strangles, straddles, earning plays, dividend capture, covered calls, iron condors, double diagonals, triple calendars, what? And have subscribed to an embarrassing number of trade services when I started. Okay, it was a while back when I started, but I went through trade services like soap. All right, it seemed like every week I was signing up for a new trade service, trying to find something that worked, trying to find my feet, and finally landed on this sort of short vol trading is essentially what it is. It's income trading, and the trick to getting good at this is to, I've written it here, it's to stop chasing the dragon, right? Like you got to stop trying to chase the dragon, right? Don't chase the dragon. I've written here, marry the ogre, right? To keep the fairy tale kind of metaphor alive. Stop chasing the dragon and find something that works and stick to it. All right, my ogre here is market neutral trading, short vol. All right, is it sexy? No, it's not sexy. It's an ogre. But does it work? Yes, it totally works. I make money in the market and, it's consistent and it works. And it's, there are some times when it's about as fun as watching paint dry, but it works, it makes money. All right, so I'm going to, hopefully teach you that trading is simple. It doesn't mean that it's easy, but it's simple. All right, it's simple and it's very challenging. So there are parts that are very simple to explain, very simple to break down, simple to understand, and yet extremely challenging to to implement. All right. So we're going to dive right in here and say, what is a butterfly spread? If you've never traded butterflies before, a butterfly spread is an option spread that consists of a long vertical spread partially financed by an equal width short vertical spread. If you are new to options, you're like, wait, what? What? And by the way, I'm going to say vol. I always mean volatility, and I always mean implied volatility. Okay, so you'll probably hear me talk about vol a few times tonight. That's just short for implied volatility. All right, so if you've never traded options before, this whole slide right here is going to be like, wait a minute, I'm in over my head. All right, so let's just do a quick, very, very brief overview of what butterflies are. I'll draw some pictures, and then we'll dive into broken wing butterflies, okay? All right, so a butterfly, and here's my disclosure. We're going to dive right into broken wing spreads here. Okay, so again, if you're new to options, this is going to be pretty crazy stuff, okay? And in the whole class, we're going to cover a lot of background knowledge. So if you are new to options, we're going to talk about what vertical spreads are. We're going to talk about what butterflies are. We're going to talk about how to build these things, how to construct these things. All the rules, all the criteria will be provided in that full class. Okay, but for tonight, we've got to move pretty quickly, so I'm just going to give you a very brief overview, okay? So a butterfly is a long vertical spread partially financed by a short vertical spread. All right, so if you've been trading options, I'll draw the old risk graph here. It's a little crooked. So here would be something like a long call vertical, right? Long call, short call. Right, here would be a short call vertical, right? Short call, I'm sorry. Short call. Long call, you can see how much I trade calls. And what we do when we're selling a butterfly is we sort of merge these two things together. If we did them with different strikes, this would be a condor, right? But what we're going to do is put them together, make them the same strikes. So there's your long call vertical, and then we're going to sell 2 times the short calls, long call, 2 times the short call, and it's going to be a trade that looks like that. So there's a long call here, a long call here, and 2 short calls here. All right, if you do it on the put side, it's the same. You have a long put spread. We sell 2 puts and a short put spread. So there's your short puts, there's your long put, there's your long put, and this would be a butterfly over here. All right, so both of these things are butterflies. And again, if that's way overwhelming, I understand. I've been there. These are both butterflies. Okay. So we're going to talk about broken wing butterflies. As I mentioned, we do have to kind of go quickly, so I'm going to kind of gloss over what butterflies are. This is about as deep as we're going to go into what a butterfly is. I'm going to go right into broken wing flies here in a second. But this is your basic butterfly. It is long 1, short 2, long 1. You can do it on the put side or the call side. All right. So as long as you're long 1 on either side, short 2 in the middle, that would be a butterfly. Okay. All right, so the fruit fly. What is the fruit fly? What in the world is a fruit fly? It is a trade that is a broken wing butterfly. So really quickly now, if we take our 2 spreads, our long spread, right, and our short spread, and with a normal butterfly, these 2 are both the same width. So you might have a vertical spread that's 30 points and 30 points. That would be a normal butterfly, right? You might have a butterfly that's 3 points. It doesn't have to be huge. All right, it can be 3 points and 3 points. It can be 10 points and 10 points. It can be 5 points and 5 points. Whatever it is, if you are trading a normal balanced butterfly, that means the debit spread and the credit spread are the same width. And what that means for the balanced fly is that you have equal risk here and equal risk here. All right, so if we think about that for a second, let's say we're using 20-point spreads. A 20-point debit spread can make $20, right? That's the max profit. Debit spread, all right? A 20-point credit spread can lose $20, right? If you make $20 and you lose $20, what are you left with? Nothing, right? So whatever you paid for the butterfly is what you can lose. So if you're trading a balanced butterfly, you can't go crazy taking losses over here or in the middle. All you can lose is what you paid for it, okay? If you are trading a broken wing fly, it's a little different. All right, so a broken wing fly, we might have a 20-point debit spread. All right, so we can make 20 bucks profit potential. All right, but instead of doing a 40-point credit spread to finance it, instead of doing a 20-point credit spread to finance it, we might do a wider credit spread to finance it. We might do a 40-point credit spread to finance it. All right, so if we take 40 points of risk and 20 points of reward, we can actually lose 20 points on this trade. Okay, it's not that we can lose 0 points anymore. Now we're taking on a trade where we can lose 20 points. Okay, and it's easier with pictures, so let me just give you the picture. So again, balanced butterfly looks like this. Okay, balanced. And this is a normal butterfly. So if you go into your broker platform and pull up a butterfly spread, this is the spread you're going to get in terms of the risk graph. All right, if you do a broken wing fly, broken wing, FruitFly, you're going to get a risk graph that looks like this. You're going to be taking more risk. You still have this sort of butterfly thing here. But then on this side, you might have no risk. All right, so you're taking all the risk or some of the risk from one side and displacing it to the other side. Okay, you can certainly tilt it the other way too. So if you wanted to take the trade and, you know, construct a bullish broken wing fly, or I'm sorry, a bearish broken wing fly, you could take the trade and set it up so that all the risk is to the upside, right? Risk and reward would be over here. Okay, so there's a few ways to set these things up. I happen to trade the FruitFly as a neutral strategy, as Don mentioned at the top of the hour here. I am not a directional guy. I am a market neutral guy, meaning I do not take, typically I don't take a bullish or a bearish position in anything. So I'm going to set this up with no bias. All right, so let's just take a moment here to pause and reflect on a couple of the common sort of complaints about butterflies. And I just want to kind of dispel a few myths here. So the first thing I always see people say, and I thought the same thing. So when you see a trade that looks like this, right? Let's say you're trading, I don't know, Facebook's at 170 or so right now. So let's say you look at a butterfly on Facebook, trade that looks like this. Let's say this is 175, this is 170, and this is 165, right? So that would be a 5-point either call spread or put spread, whichever. 5-point call spread, 5-point you know, call credit spread, 5-point call debit spread. So a 5-point fly. All right. You're probably going to pay nothing for this trade. And people look at it and they say, oh my goodness, there's no way I'm ever going to land right there. I have to land right at 170 to make any money on this thing. Anywhere else above 175 or below 165, and I'm losing money, right? Like I'm in the loss zone unless I hit this thing right on the nose and it goes right to 170. All right, and they look at it and say, this is just such a low probability trade. Why on earth would I ever take this trade? And it's a good point. I think if you ask long-term traders, like long-term option traders, how often they actually hit this thing on the nose at expiration, it's like a once in a career kind of trade. Like you're not going to do this, you know, you're going to do it once in, you know, 30 years. It's never gonna pin this thing. They call it pinning the fly. It happens like once in a blue moon. So yeah, first complaint here is you know, why not just flush money down the toilet? Just why even buy these things, right? And my answer is that probability is always tied to risk and reward. So if if we look at this trade, if we look at this trade, the lower the probability is, the lower the risk is, right? So you're going to be able to put this trade on for, I don't know, like a nickel, and you can make, you know, $495 or something. You know, so like these two things, if something costs 5 cents and you can make $5 out of it, the probability of that trade making $5 should be like nothing, right? It should be like less than zero. So yes, you're right. The probability is extremely low of making max profit on the trade. Okay, so what I always tell people is stop looking at the expiration line. When you take a trade that looks like this, your butterfly here, you have to look at what's called the T+0 line. That's the current profit and loss line. And what's going to happen is over time, your T+0 line is going to look like this. You're going to have profit anywhere between here and here. You're actually going to have a much wider profit zone than what the expiration graph shows. All right, so if you are new to trading butterflies or considering trading butterflies, please, if you take nothing else out of this presentation, ignore the expiration line. Do not look at the expiration line. Just look at your T0 line. Okay. All right, next complaint. Why isn't this called the commission monster? There's like 8,000 legs to this trade, right? So similar to iron condors, if you trade iron condors, that's a 4-legged trade. This is a 3-legged trade, but has 4 contracts. So it's the same as an iron condor. It's going to eat up some commissions, yes. But my rebuttal to that is, first of all, many brokers are pretty much just in a race to the bottom here on commissions, which is great for retail traders, right? They're just getting cheaper and cheaper and cheaper. And you know, you've got some brokers that are even doing like free trading now. Yeah, I mean, just wait it out a little longer, and maybe commissions won't even exist in a couple of years. You know, the second point, if you're making money, like who cares? If you have to pay commissions to make money, like who cares? Net, you're making money, so it doesn't matter. And then the third point here is, you know, if you're patient with your executions, so like if you can wait out an order and not give up a nickel on the entry, you're going to make so much more money than the commissions that it's just a wash at that point. It's a losing argument. And by the way, I'm not trading this thing to expiration. I just saw a question pop up. I do not trade this to expiration. Most people that trade flies do not trade them to expiration. Okay. And the last point I'll make here on the commissions is if you are a TheoTrade member, TheoTrade has a number of deals set up with brokers to offer discounted commissions. We can't actually tell you what they are, but if you want to throw a question into chat and ask about it, we can tell you in the chat. We cannot do it publicly. All right, so we do have some cool deals set up with various brokers for commissions. Okay, and the third complaint. Hey, this whole thing's too complicated. TLDR. I ran this by Don earlier. He's like, what's that? So for anyone that is over the age of 35, I think I'm still technically in that. I'm in the, well, I'm not in the under 35 category. I'm exactly 35. So anyone that is not familiar with TLDR means too long, didn't read. And yes, we have the millennials to thank for that acronym. So if it's too long, didn't read, let me just ask you, are you serious about trading? Because trading is not easy, folks. It's not easy. It doesn't have to be crazy complicated, but it's not super simple. All right, so it's not a paint by numbers kind of thing. All right, what we do at TheoTrade, though, we give you criteria. We give you step by step. We're going to break it down and tell you exactly what to do, when to do it. So it's more like putting together a piece of IKEA furniture. It's not like the easiest thing in the world, but you can follow the list and get it done. And one of my favorite quotes here, anything worth doing is difficult. That's a quote from me. I'm sure someone has said it much more eloquently than that, but I did used to tell students that all the time. Anything worth doing is difficult. All right, so why in the world do you want to trade this thing? We don't even really know what it is. We just know it's a broken wing butterfly. But let's talk about why you might want to trade it. When you set this thing up properly, it offers a superior risk-reward probability setup that has statistical and demonstrable edge. Two of those, and you need edge. If you don't have edge, you're just throwing money in a black hole. All right. Someone's asking me if I'm Don's clone. I sound so much like him. I don't think so. I don't think so. So yeah, when you set this thing up and manage it properly, it offers a very favorable risk-reward probability setup. Okay, and even you know, if you like to trade verticals, you should look at butterflies. All right, a butterfly can function very much like a cheap or a cheaper vertical, offering a lot of the same upside, but just for cheaper. All right. Next thing, it is a highly flexible and adjustable trade. Let me just draw one more picture here. All right, if you look at a butterfly, and you look at an iron condor, so there's our zero line, here's our zero line. You look at an iron condor, the way people usually trade them looks something like this. With an iron condor, this is all you have to work with if you're trying to adjust out of that trade. With a butterfly, this is what you have to work with. You have a lot more juice in the fly than in the condor to make adjustments and you know, kind of tweak this thing and pull it back into a winning trade. So there's a lot of adjusting that goes on with butterfly trading. All right, and because of that, it's an excellent tool to begin learning to properly manage complex options positions. Okay, I can look at a book full of options that I didn't put on, and I can look at the Greek profiles, I can look at the second order Greeks, and I can tell you how to mitigate risk. I can tell you what to do with it, because I've learned how to trade these things well and read the Greeks and understand what's going on behind the trades, behind the Greeks, behind the risk. And it's because I learned how to do this. I didn't know how to do that stuff before I started trading. Before I started trading flies. Okay, I dabbled in some Greek stuff with like double diagonals and some iron condors, but it didn't click. It did not click until I started trading butterflies. Okay. All right, so how is this thing different from Joe's fuzzy box trade? I don't know. You know, there's a lot of trades out there with silly names. The speaker tent trade, and this trade, and that trade. You know, how is it different from just an iron condor or a long call or a short put or, you know, whatever trade you want to come up with here? So one of the differences I just mentioned, we manage the position by the Greeks. So we're not looking at price levels. We're not doing stops. There's a profit target and there is sort of a price level stop, but for the most part, our management is using the Greeks of the trade. So it's actually using the dynamic risk of the trade rather than price levels and stops. All right, and again, this allows for a more dynamic trade and a better understanding of risk. You need to understand risk if you're going to be successful in this business. All right, the criteria we're going to give you covers every market scenario. All right, we're going to tell you when to adjust it. We're going to tell you how to adjust it. We're going to tell you what to do for each adjustment. And then the class itself will kind of we'll break down the, what's going on behind the fly, why it's priced the way it's priced, why it has the edge, that kind of thing. And it has a statistically high win rate. Especially if you're new to trading, you got to build up some confidence. And one of the things that's nice to do that is if you're winning a lot. If you're winning 8 out of 10 trades, you're going to have a lot more trading confidence than if you're winning 1 out of 10 trades. And, you can actually make money winning 1 out of 10 trades. You just have to make sure your winners are huge and your losers are small. All right. But it is nice to have lots of winners. Okay. Dave, sorry, I know you guys can't see the chat. I will show examples. I promise. I promise. Okay. Trigger warning, some math stuff here. So if you hate math, cover your ears. All right. So let's take a look at just some comparison here. So the H, the L's, and the M's, that is short for high, low, and medium. All right. So if we are looking at some common strategies that people trade, iron condors, the way they're typically traded, have a low reward, a high risk, but a pretty high probability. All right. So we're going to, I'll censor the expression, but we're going to eat like a mouse and poo like an elephant on this trade. We're going to make lots of small gains and eventually just poop it all back out later on with one big massive loser. All right. If you traded condors, you've been there. My first time trading condors was, I think it was October of 2014, maybe. Big, nasty, ugly market environment for trading a condor, big, ugly V bottom. Just hit a big loser right out of the gate. Always feels fun. A long butterfly. All right, again, most retail traders don't trade long butterflies, but if you do, it's very low risk. It's very high reward, but it's very low probability. If you look at these two and compare them, they are basically the opposite of one another. Right, an iron condor and a long butterfly, kind of the opposite trades. Right, let me get rid of the ink here for a moment. At the money verticals. Right, a lot of people like to trade at the money verticals. That would be buying a call and selling a slightly higher strike call. You basically have medium across the board. You got medium risk, you got medium reward, you got medium probability. You can actually move the vertical around and tweak these a bit, but to keep it simple, an at the money vertical has, kind of if you've ever done the old wrestling video games, this is like the character that no one wants, right? Like he's got some stamina. He's got like a special move that's kind of cool. He's got a song that's kind of cool. He's got a little bit of power, but like everybody still beats him because he doesn't do anything really especially well. All right, out of the money long options. This is the old flyer call, flyer put. Everyone does at first. They see Apple trading at 200. They go out and buy some 250 calls. They're like, I'm going to make $1 million, and they just lose all their money, right? Very high reward, very low risk, very low probability, right? You're just going to lose money over and over and over again. And occasionally you might hit a huge winner, right? And people trade like that. People make money that way. If you can hit the occasional huge winner and, not blow out your account in the process, you can do it. Out of the money short options, very high risk, very low reward, but very high probability. Again, if you look at these two, they are polar opposites. So a lot of retail traders will eventually settle on like short spreads and this kind of thing. And I actually do a lot of out of the money short option selling, so I don't mind this strategy too much. But it does carry a lot of risk. So if you're looking to trade in an IRA account or some kind of retirement account, short options that are just naked short options, usually not an option. Pun intended, obviously. So you can't do that in like an IRA account. But the FruitFly, let's look at it. It has low reward, high probability. So you would expect the risk to also be, fairly high, but it's like a medium risk kind of trade. So when you lose, you don't lose that much money, and you make a little bit of money, and the probability is very high, right? So it has a favorable risk reward probability profile. Okay. So all that math stuff. We'll go through the trading mistakes, and then we'll dive into some examples here. So again, looking at the expiration graph, if you're just starting out trading flies, don't look at the expiration graph, guys. Do not do it. It's very tempting. Don't look at it. It's not there. All right, not adjusting the trade. If you're trading butterflies, you got to adjust it. You got to sort of move with the market and take the profits as they come and move the risk around. You don't have to, but it's there's so much credit to work with that you're not ever going to realize. If you look at a butterfly, this much of the trade up here, you're never going to see until like expiration day. So you might as well take that part of the trade and like lock it in, put some rewards. I feel like I should make a face out of this. you should do some stuff and make some adjustments and kind of lock in your profits and stuff. So if you're just starting to trade butterflies, learn how to adjust them. You got to learn how to adjust them. And then the last thing people do is ignore volatility. All right, volatility is a huge part of trading butterflies. If you don't understand the volatility, you're going to get run over, or you're going to make a lot of money, and you're going to not have any idea why. You're going to see your P&L jump, and you're going to be like, "What happened?" And hopefully it goes well for you. Hopefully you're on the other side of it where you make a bunch of money and have no idea why. But ideally, you know what's going on. You know why you're making money and losing money. So don't ignore volatility. You need to understand volatility. Okay. All right, so an example trade. Here we go. What everybody's waiting for. Here's what the trade looks like when you put it on. All right, this is the SPX. Yes, you can do this on the SPY. Yes, you can do this on the Russell. Yes, you can do it on the IWM. I designed it for the SPX, so that's why I'm using the SPX. That's what I tend to trade it on. But yes, you can do it on those ETFs or the Russell. Okay, so here it is. It's a broken wing fly. It's a long put. There's our long put. Then it's 2 short puts, which turns the graph down like this, and then it's 1 more long put to cover our risk. All right, this is a fixed risk position. It carries exactly $2,000 plus the debit. So in this case, this trade carries $2,240 of risk. All right, if you did it in the SPY, just divide everything by 10. So if you did it in the spiders, 1 contract would carry $224 of risk. Okay, and I should point this out before going any further. We do save some capital for adjusting the trade. Remember, I mentioned that we're going to adjust the trade, so we're saving some capital. So we actually put aside $4,000 if we're trading the SPX, or $400 if we're trading the spiders. All right, that extra couple $1,000 is going to go toward our adjustments later on. All right, so just to kind of talk through some of the management here. If the market moves up, we are selling put verticals against our structure here. All right, we're going to sell some put verticals. Which ones are we going to sell? That's what we're going to talk about in the class. We're going to talk about which strikes we sell. We're going to talk about how to know when to sell them. We're going to talk about what it looks like to sell them versus what the position actually does. We're going to talk about all that stuff in the class, which strikes, which expirations, all that stuff. All right, if the market moves down, depending on when it moves down, we might buy some verticals, or we might just close the trade. All right, or we might take profits depending on depending on the scenario. So again, we will cover all those specifics in the trade. I'll show you some trade examples in a minute so we can actually kind of walk through, and I'll show you what a trade cycle might actually look like. But essentially, that's what we're doing. We're starting with a broken wing trade, and if you look at it right out of the gate, it looks like, hey, there's a pretty decent chance of making money. We could land right in here. All right, if you had that thought, you're looking at the expiration graph. Stop it. All right, don't look at the expiration graph. But what happens is over time, this T0 line, this purple line, which is what I want you to look at, spreads out. So it looks something like this. All right, so you actually have a zone that's like this big in which to make some money. But again, we're going to be adjusting it anyway. So don't worry too much about this because it will tweak and morph on you. Let's see, someone is asking how I got 224. Debit was 240. Dave, I may have just gone dyslexic on you. I'm sorry. The debit for the SPY would have been $240. Sorry, it runs in my family. Both my brothers are idiots. I hope they don't ever watch this. All right. So yeah, it would be 240 in the spiders and 24. You know what? No, I'm sorry. I'm sorry, my brothers also. So it's 240 plus the $2,000 of risk. So actually the risk here is 2240. And if you're doing it in the spiders, just shave a decimal off. So the risk actually would be 224. I really hope my brothers never watch this. They'll be very upset with me. All right. So yeah, again, if we go up, we're going to be selling put credit spreads against our fly here. And if we move down, we're either going to be exiting or buying credits, buying put debit spreads rather to hedge us. A lot of times people ask, hey, can you do this on the call side? Hey, can you do this with iron butterflies? If you're familiar with butterflies, yes, you can certainly do both of those things. I do it on the put side. I like puts. I'm comfortable with puts. Puts are like a familiar warm blanket. Calls scare me. I don't like calls. All right, so that's what the position looks like when you put it on. And let's just go through a couple of examples here. So let's see, pin. All right, so in this case, I opened the trade on 6/19 of 2018. These were live trades. So this was about two and a half months ago. So open the butterfly for 235 debit. And if you look at the strikes here, remember I said we're breaking the wings here. So if you look, this is a 40-point debit spread, and this is a 60-point credit spread, right? 40-point debit, 60-point credit. So there's 20 points of risk in there, right? So 20 points of risk plus a 235 debit gives us a trade risk of 22.35, or if you're doing this in the spiders, 223.50. All right, so we put it on for 235 debit. The very next day, we're already adjusting. All right, we were adjusting. We're selling some stuff for 225. That mitigates almost all of our initial debit. So now we have a 10-cent debit. Oops, oh, that's not going to look like debit. All right, you got to pretend that's debit there. All right, 10-cent debit. And then the very next day, 6/21, we're buying some verticals. So now we're back in for $1.10. So we're up to $1.20 debit. And then it looks like a couple weeks went by here on over to July the 6th. Now we are selling some verticals for a 75-cent credit. So now we're down to, oh boy, math, 45-cent debit. 45-cent debit. And then we're selling off actually 2 times the quantity here of 30 cents. So now we're at a 15-cent credit. Now we're net positive in the trade. And then we close the trade for a 35-cent credit. So what did we make? We made 50 cents. All right, so it's a $50 trade. I take the quantities off on these. Someone's asking, hey, where's the quantity? I take the quantity off. They're all the same quantity except for this trade. You know, when people are talking about trades and stuff, people, you know, sometimes if they see my quantity, they may think, oh my gosh, I'll never be able to trade that, or oh my gosh, this guy's trading so small. It's all subjective, so I like to take the quantity off, so as just to show the raw trade. So, you know, you can do this with a 1 lot, you can do it with a 100 lot. It does not matter. Okay. Let's see. All right, another quick example trade. This one I did right after the volatility explosion in February. So I put it on 212. If you were trading back in early February and you're still alive, congratulations, you made it. You made it through a horrible volatility explosion. All right, so this was put on about a week after that vol blew up. The blow up was like Feb 6, Feb 7. So it's put on the 12th. So put it on the 12th for $1.40 debit. Adjusted it 2 days later, adjusted it 1 day later, adjusted it 1 week later, took it off 3 days later. So 1, 2, 3, 4, 5 total trades. If we tally everything up here, that's a 250 credit against a 140 debit. So we wound up making a $1.10 on the risk there. All right, so let's talk some risks and considerations for a minute. So this trade works incredibly well if you follow the plan, right? But there are some risks to be aware of, as well as some other considerations that can either enhance your profitability or cause big losses if not fully understood. All right, so let's talk volatility for just a moment. I just mentioned the volatility explosion in February. So as I mentioned earlier, all butterflies are to some extent influenced by volatility. All right, generally speaking, the more delta a trade carries relative to the capital, the less the volatility effect will be. So if you're trading, you know, like a very, very long position or a very, very short position, you're probably not going to have to deal too much with volatility. However, our strategy here, the FruitFly, carries no delta. It is a 0 delta trade. All right, we're putting it on basically flat delta, meaning we do not have directional exposure in either way. All right, we're not bullish. We're not bearish. That means the vol component is very, very important. All right, volatility is going to be very important, a very important profit driver in the trade. All right, so if you are going to trade this, the ideal time to trade it is when the RVX, that's the volatility index of the Russell, or the VIX, which is the volatility index for the S&Ps, is between 12 and 20. All right, if it drops under 12, which was like most of 2017, if you watch the VIX, most of that year volatility was like in single digits. It's crazy. All right, that's not a great time to trade this thing, because when volatility expands, the trade's going to get hurt. All right, we'll go into that in the actual class, but in this case, you don't want to be trading it below 12 on the VIX. All right, if volatility is above 20, it works fine as long as the market's not moving crazy big. And generally, if the volatilities or if the VIX is above 20, the market's probably moving pretty big. Okay, so probably keep it, keep the trade between 12 and 20. It did work out on that February trade I posted. I think vol was up in the probably upper 20s, maybe even 30s at that point, and it worked out fine. But there is some directional sort of whipsaw risk if you're trading with with the VIX above 20. Interest rate considerations. This one's kind of a weird one. Nobody ever really talks about interest rates because they've been zero for so long. So no one's really been piping up about interest rates. But because they are starting to increase, it's important to think about them. So in this case, there is a way to earn interest on the capital you have in the trade. So remember, we're putting $4,000 into this trade. You can actually earn interest on it. All right. If you don't do this, you're leaving money on the table. Okay. And there's a small reason not to do it, but you really should be trading this thing to take advantage of interest rates. All right, especially with them climbing, above the 2 mark, and actually having some interest rates these days. Skew risk. All right, there's not a ton of skew risk in the trade, but it's helpful to understand what skew is so that you know what you're buying and selling. Skew is essentially the difference in implied volatilities across the different strikes. So if you buy an at-the-money option, your implied volatility might be one thing. If you buy an out-of-the-money option, your implied volatility is going to be something very different. And skew changes as volatility changes. So just something to know about, something to think about when you're trading this. We will talk about that in the class as well. And the trend is everybody say it with me, the trend is your enemy. Let's write it in here. Enemy. If you've traded iron condors, you know the trend is your enemy. All right, everybody thinks the trend is your friend. I'm not friends with the trend. I hate trending markets. This strategy does not like trending markets. It will still generally produce modest profits in a bull trend. And once that volatility expansion occurs as a bearish trend begins, it's not going to take that much heat. It can hold up to a pretty decent bearish trend. I put moderate here. It's not going to hold up to like a crash. Okay, a crash is going to knock you out of the trade. But a moderate bearish trend, if there is such a thing, the trade will hold up just fine. If you choose to, I don't usually do this, but if you choose to, you could use some momentum indicators. You can use your directional indicators. If you're a chart guy, if you're a technical analysis kind of guy or gal, you can certainly use those things to time your entries if you choose to do so. I do not. And I think this is the last risk slide I have here. Assignment and dividend risks. This really applies only to the spiders or the IWM. So if you're trading this on the SPX or the Russell, you can ignore the assignment and dividend risks, since there is no assignment on European style options, no early assignment that is, and no dividend risk on those 2 underlyings. But if you are trading on the spiders or the IWM, there is a dividend risk, and right around X dividend, you also have an early assignment risk for the call side, if you're doing it on the call side. All right, the put side, you can usually dodge both of those risks, but you do have some ex-dividend stuff to pay attention to if you're trading the spiders or the IWM. All right, and if you're trying to do that in an IRA account, you really got to be careful, because you're not allowed to be short shares in an IRA account. Okay, you can't do it. It's not allowed. All right. And let's see. All right, I think that takes us to the end of this presentation for now. All right, fear not the fruit fly, and I'm going to throw it back over to Don in a second, but I just want to say a few things here. So if you don't know options, or you have limited options experience, placing trades, executing trades, that kind of thing, don't worry. We're going to show you. We're going to hold your hand through this whole thing. Okay, we're going to do coaching sessions on this thing. We're going to show you exactly how to do this. We're not going to let you go blind. All right, we're here to help you. We're here to support you. We are not going to let you trade blind. All right, we will lay out everything you need. We can place you how and when to place the trade in a matter of just a few hours. And TheoTrade creates detailed recipes for every strategy, including the fruit fly. All All right, as Don likes to say here, you wouldn't bake a cake without a recipe. You wouldn't fly a plane without the instruments. So why on earth, why would you trade without one? And I did promise you one more thing here in this presentation. It was the 2 things needed for profit in the market. Number 1, and this is the easy one. Okay, this is actually the easier one. A solid trade plan with quantifiable edge. If you have a trade plan that has edge, you're halfway there. All right, a lot of people trade without any kind of plan, and they lose money almost indefinitely. They lose money. I've been there. I'm sure you've been there. I'm sure Don's been there at some point in his career. If you go in without a plan, unless you've got just killer instincts and can read the market, read the tape, that kind of thing, you know, you're probably just going to lose money hand over fist without some kind of edge. You got to have edge. You got to have edge. All right, the second thing you need is willingness and support to follow that plan no matter what. Once you have your plan, you got to follow it. You got to follow it to a loser if you need to. You got to follow it to winners. You got to follow it to losers. You got to follow it. All right, if you're trading solo, it's difficult to do this. If you are trading on your own and you're in a rough situation, it's tough to follow the plan. All right, so you got to have a plan. You got to have a plan, and having support is really, really important as well. So if you have other traders looking out for you that you can bounce ideas off of, it's invaluable. So those are the 2 things you need.
So we're going to answer a couple of questions as we go along here, and I want to thank Matt for coming on. And I'm going to take you guys through a couple of things about Matt's upcoming class. And Matt's going to answer some questions in the chat room. Then I'm going to have him back on at the towards the end of the presentation here this evening for kind of walking you guys through a little bit of some of the details. And what he was mentioning is absolutely true. Everything breaks down to criteria. It's what we effectively do. When you look at this strategy, and really any strategy for that matter, it's all about, you know, what you need to know. So a lot of questions on like, what stocks do I trade this on? First of all, you can absolutely, use this strategy on equity products. However, it was initially designed for European style options. We've actually adapted it, though, very effectively for both spiders and IWMs. We're going to help you determine, you know, how to determine whether you're bullish or bearish. People always ask me that, which cracks me up because, wait, this is actually a neutral strategy. We're going to talk about expiration selection, strike selection, position sizing, the correct probability for the trade. How do you execute the trade? When do you exit? When do you roll? What do I do in a losing position? It's all going to be covered. And as Matt was alluding to, we're going to do a class, and the class is coming up this Saturday on this. And we want everybody to know, hey, listen, yes, there's a means to an end, and there is a class on this, but here's specifically what's going to be covered. We're going to talk about the good candidate for it, the expiration cycle, the capital commitment, the strike prices, all the little details, all little nuances. In fact, I've actually looked through Matt's slide deck already for this coming Saturday's class, and he actually has everything like broken down into a flow chart, which I think you guys will really, really appreciate. When I say a flow chart, if this happens, do this. If this happens, do this. And it actually takes you through the flow of the entire trade. Again, what if the market sells off big? What if the market's flat? What if the market rallies massively? Again, rolling the trade out. We have all the answers to that because, well, that's what the class effectively is. It's building a recipe around this, the how, the when, the why, at what price. It's just the beginning, though, of the variables you're going to face in the FruitFly spread. And we always say kind of the secrets in the sauce. But one of the things, before I get into the secrets in the sauce, one of the things is, fear not the FruitFly spread. Listen, this is going to be, a fairly intensive course. However, we have all the background knowledge that you're going to need, prior to the course. And we are not just going to throw you into the deep end of the pool on a FruitFly spread like this, We're going to provide consistent support even after the course. And it's one of the most important things that I want to really emphasize tonight is, we spent years fine-tuning this trade setup. And by the way, this particular trade setup is a variant of something that we were doing even 20 years ago. So we've approached this, really systematically. And again, it's all about following the steps and the criteria to effectively build a FruitFly trade. This is the FruitFly for consistent income class. This is the actual curriculum for the class. So we're going to take you through how to actually build it. everything from, the risk reward, which is risk 1 to be able to make 6. Okay, that'd be a trade that would be a bit of a home run in there. Okay, and a lower probability. Nevertheless, okay, we're going to walk you through all the risk reward and all the probability, the full entry and exit criteria. You're going to know exactly step by step how to generate, okay, the fruit flies on a month-to-month basis and how to produce income, how to hedge the fruit fly so you're not going to have to take an extraordinary amount of risk. Again, I also at this point want to reiterate that when you're looking at it, people go, he was talking about $2,000, okay? Do it in the SPY, it's $240, okay? Or even smaller, the IWM, or even smaller, maybe the QQQ. Any one of these ETF products can be absolutely viable. All right. And, there's even other ETF products that have really come up in terms of liquidity. Stuff like EEM. You ever think about EEM? Right. I mean, we're talking, an under $50 product is the EEM, one of the most prolific in terms of volatility. So when Matt was mentioning a moment ago between a 12, okay, and 20 volatility, between a 12 and 20 volatility, well, the emerging markets is almost always between there. There's always going to be a product that you can trade and that you can utilize for this. We're also going to lead you to the right strike prices for the highest probability, how to use different kind of fruit flies, right? That's, by the way, that's a tongue twister over there, for various market conditions, right? And the proprietary triggers to manage your fruit fly. And when I say the proprietary triggers, that's the actual flow chart. And by the way, the flow chart is going to blow you away at this class. Again, we've brought on a lot of different instructors here. Since we started TheoTrade, this is, 6 other instructors we've hired. This is the class that I think we're going to be, for the most part, one of the most, proud class offerings that we're going to do. Class is coming up specifically this Saturday. The trade instructor is Matt Williamson. It's going to be far more in depth. Okay, we can do a lot more in 3 hours rather than Matt here in 30 minutes. And class is live Saturday, September 8th. It's 9 a.m. to 12 p.m. Central Time. The class slide deck that includes all the entry and exit criteria, the checklist, is available for download on September 8th, the morning of September 8th. The class qualifies you for reduced commission rate, TD Ameritrade. We also now have a deal with Tastyworks and a deal effectively with E-Trade. The class price is $199. We do have a bit of a deal though today. Now, this is the part where I want to differentiate. By the way, mark your calendars for Saturday. People, well, I'm not going to be available Saturday morning. It's a little short notice. It's not that short notice, okay? And believe me, the NFL games, we're not going to do it on Sunday. We're not going to do it on Thursday. We're not going to do Monday night, right? But listen, it's going to be archived immediately. So if you can't make this exact time frame, of course, it's that recording available to you immediately. After we record it, we literally post it instantaneously. Now, this is the part where we want to differentiate from anything and everything out there. And, people always kind of, I've been there, I've done that. And people have tuned in, and Matt was alluding to this too. People have tuned in through the gauntlet of paid classes, indicators, what I call secret squirrel, black boxes. And it's chasing, I love Matt's comment on here, chasing shiny objects, all right? Only to find you got to buy one last thing, make a difference. Now, I talked to somebody the other day locally here in town. I live in Scottsdale. I talked to somebody the other day that's a client. I met him for a drink. He was telling me he had spent over $30,000 in education before finding TheoTrade. And we've just had enough of that, enough of the educational garbage, the sales pitches, and we're going to put a little bit of an end to it. All right, we're hiring traders. We're not hiring, professional salespeople. We're here. We're built by professional traders with a minimum of 15 years of experience, not professional salespeople. I mean, I have to go through here and listen. Do we have to have people attend classes? Yes. Okay. But at TheoTrade, we're building this means to an end. We're building, if you will, the Netflix, of trading education. And educating you, it's our only goal, and we're going to demonstrate that. And we've introduced now TotalTheo. It's unlimited streaming monthly membership. Okay, what is it? What is that? What does that amount to? Well, we intend to disrupt financial education. Unlimited TheoTrade, which is just TotalTheo unlimited monthly streaming. It's just $99 a month. Okay, it includes the FruitFly. Okay, it includes the FruitFly consistent income course. But the reason we do this is at 99 bucks a month, you can get all the support you need. We don't just put you in a $1,000 class, and then after the $1,000 class, they're like, boom, there's the door. Okay, forget that crap. We have access, okay, to over 72 trading classes. All are available immediately on demand. And there's new monthly classes. Guess what the FruitFly is? The FruitFly is. It's our new monthly class for the month of September. Okay, just so you guys know, there's also going to be another home run number of courses in September. Okay, you guys are going to love what we're about to do. Live trading chat room. This is all included at $99 a month. Okay, this is a trading chat room. It broadcasts live 6 hours a day. Now, I don't want to get away from the FruitFly class idea over here, but if you need help at all, we're broadcasting live 6 hours a day. What do you think we do during the day? We answer questions, and not everybody can come in during a trading day. That's okay. We record that too. There are 59 proprietary indicators and scans. We email out trade ideas. One of the key things that we're going to be talking about during the course, this FruitFly, we're going to email you out the FruitFly. We're going to email you out the rolls, okay, the adjustments, all of it. Why? Because you need your hand held when first getting in to premium generation strategies like this. I've been doing this for 20 years, of which in my 20-year career, okay, just over 15 of those years, right, I've been educating. And for a period of 5 years, I ran education for 7 million clients. And I'm telling you right now, you can't just like take a class and then try to produce anything and everything that the instructor did. You need a helping hand. We do daily coaching sessions, timely topics. Instructors will directly answer your trading questions. It's TheoTrade.com/all. Now, we do offer you, if you just want to buy the FruitFly course, you can pay $199 one-time fee. Or you could do TotalTheo unlimited streaming. It's $99 a month. It's the FruitFly class, okay? Plus, it's actually another 72 classes. There's new monthly classes, live trading chat room. Everything's archived. We have daily coaching sessions, trading indicators, email trade ideas. Everything's archived again 24/7. And that's why we suggest, hey, listen, it's like we're giving you $100. Take the money. Why wouldn't we do this? We're actually going to save you $100. Why? Because we're so convinced that you're going to enjoy what we're doing here at TheoTrade, and you're going to be successful in what we're doing here at TheoTrade, that we're going to give you $100 off. And that's why, okay, we do the $99 per month. Let me actually pull up the site. I'm going to show you a little bit about TheoTrade, and then I'm going to have Matt answering some questions. This is the actual site. It's TheoTrade.com/ALL. Again, TheoTrade.com/ALL. Just hit add to cart. It's $99. All right. One of the questions that always comes up, all right, is that, is this, a monthly membership? It's a monthly membership. You can cancel it anytime. All right, listen, we're both going to part ways as friends. If you just want to go to the FruitFly class, and have a month of it, that's fine. Okay, listen, no hard feelings. It's 99 bucks. It's not going to be game changing. One cool thing though, you sign up, you can get a commission discount. TD Ameritrade is probably one of our better commission discounts. If you have an existing account or you want to open up a new account, let us know because we can actually take care of you on that. Do not call them, do not email them. We actually take care of it on our side and give you directions of how to receive the commission discount over here. And again, at 99 bucks a month, all right, you can cancel anytime on there. Now, it's TheoTrade.com/all. Let me show you a few things, and then we're going to answer a ton of questions in here. This is what the TheoTrade chat room looks like. Okay, so there's a chat room. You can chat in. You can type in stuff. You can post apparently a YouTube video over here. These are all of our clients. There's hundreds and hundreds of people logged in here. And as we grow TheoTrade, we're constantly adding new instructors. So this is what the chat room looks like. Obviously, it's off air. That's going to broadcast 6 hours. But this is where you're going to go for the class on Saturday. All right. Next, start here. What is start here? Well, it's important that you know, okay, that there is basics. So somebody comes in here and they're like, yeah, this actually sounds pretty cool, but I don't know anything about options. Great. Options 101, options 201. Now, should you go to the class this Saturday? Absolutely. Grab big concepts. And then if you have to, go back and watch some of the basics in here. If you're like, I don't even know what a butterfly is, we can help you with that. Okay, here's all the classes that we currently have archived. I told you there were 72 classes. Here's option strategy classes, right? Just click right on where it says option strategy classes. Guess what, right? Come through, there's covered calls and getting short, butterflies glide to weekly returns. Okay, that's a class that's already in there. Everything. It's $99 a month. You can stream and stream and stream till your heart is content. All right. That's why I kind of call it like the Netflix, if you will, of the trading community. And maybe you don't like, me. Maybe you like Matt. Maybe you like, Corey Rosenblum. Maybe you like, again, Jeff Bierman. We've each got sections in here under the archives. Look, all right. Jeff is in there and Slim is in there in the class archive. And if you want shared charts, scans, and studies, $99. You get everything in here. Some of these things, again, people would charge thousands for this. These are all the links to all the different studies for a variety of different platforms. The other thing is, this is the member home. The archive is searchable. You can come in here, afterwards and like FruitFly, okay? Any of it. All of it is encompassed in here. Now, I'm going to answer a couple of questions. Again, TheoTrade.com/all. We're also here. We are here. And when I say we're here to answer some questions. So you can start up a live chat with us if you so choose. I mean, it's pretty straightforward. Again, people always ask the question. It's in here right now, okay? And the question is, is this a membership at $99 per month? Can I cancel anytime? Answer is absolutely, you can cancel. A lot of people ask the question, can I do this in an IRA? That one's also in this. Yes, you can do this in an IRA. All right. I trade in my IRA now. That okay with everybody? Okay. I trade in my IRA. Is there anything in terms of like day trading margin rule? That's something I can actually help with extensively. Okay, if you're on board, if you have trouble with the day trading margin rule, I spent 15 years in the brokerage world that can help you guys navigate around it. It's one of the reasons I'm kind of answering a few of these questions. If you can't make it live, the class is absolutely recorded. Now, I know that there's so much at TheoTrade. Okay, I mean, in terms of like, bang for your buck, I'm going to tell you right now, you couldn't spend $20,000 and get the education that you're going to get here at TheoTrade for $99 a month. Okay. And I challenge people all the time. I'm like, oh yeah, find something that has archives anywhere near the depth. Okay. For any amount of money. You can't find it for any amount of money. So we try to be the one-stop shop, whatever genre of trading you are. In terms of technical analysis, Matt talked about market neutral. You're into technicals and charts, we got you covered. If you can't get your head wrapped around options, we got you covered. We have everything you're going to need to not only get started in this business, to be successful in this business. So with that, we're going to thank Matt. We're going to let many of you go this evening because we've eaten up the full hour. Matt is feverishly typing answers to questions into the chat room. And I want to thank everybody for coming out this evening. And please do, tomorrow morning, I'll be the first individual in chat tomorrow morning. Feel free to chat in early in the morning, and that's right here in the TheoTrade chat room. Type in, hey, brand new, nice to have a first day in here, and we will be glad to see you guys in the chat room tomorrow. And again, of course, at the class this Saturday, and it's important to also note, we will email out, remind you of the time of the class. So by all means, if you need that once again, okay, the class itself is Saturday, September 8th, 9 a.m. to 12 p.m. Might run a little bit over there. And the link you need today is theotrade.com/all. Thanks everybody for coming out tonight. Have a wonderful evening. Bye-bye.